It is August 15, 2024, 6 p.m. Eastern Time. I welcome everyone to this very exciting Options Secrets webinar. It is going to be a live market discussion with our special guest, the Option Professor. Oh boy, what a week it has been. A crazy rally in the indices early this week. Then CPI came out, and then everything went kind of flat. I'm super excited to see what the options professor's take on all this is. So, guys, please be comfortably seated and let's get started. And of course, a quick reminder that this session will be recorded and the recording will be sent to you afterwards. So should you need to drop off for any reasons, don't worry. You will get the recording afterwards. Now, also a quick reminder that options trading or any trading really does contain substantial risk and therefore is not suited for every investor. If you trade, make sure to only use risk capital, which is capital that you actually can afford to lose. When it comes to backtest performance or hypothetical performance, keep in mind that this is not necessarily indicative of future performance, and any trade ideas and setups shared in this webinar should not be construed as trade advice. These are for informational purposes only. Now, let me actually introduce myself. My name is Daniel Sinek, and I will be mainly your moderator throughout this session. I am a managing partner of tradingindicators.com, your number one online store for all your trading needs. We have been in business for more than 10 years, and we have built numerous trading indicators, fully automated strategies, trading scanners, trading dashboards for clients all over the world. Most of them are rooted in what is called technical analysis, which is basically a pattern analysis, a mathematical analysis of your price chart. We believe that fundamental information is almost immediately priced into your chart. And therefore, by doing a technical analysis of your price chart, you will indirectly also take into account fundamental information. Now, it is time now to introduce our special guest. As you can probably imagine, we have invited once again the option professor today to share with us his view on the markets and how he's interpreting these CPI numbers that came out yesterday. So, option professor, are you there today?
I am.
Hello. Yeah, please introduce yourself for those of you who may not know you yet and what your background is.
Sure. Thank you, Daniel. And it's great to be here as always. We're going to go over a lot of information here today. Just a quick background on myself. I'm a graduate of Boston College, and I attended the advanced option training at the Chicago Board of Options Exchange for advanced option training. And then, of course, I was in the investment field for a long time. And I've done seminars throughout the nation and in Canada on the uses and risks of options. And so I've trained a lot of traders on the options area, and I'm very familiar with the product of options. So I'm certainly a person who can help you with information on that. Of course, I was one of the conductors, along with Daniel, of the options masterclass, where we go into all the details of options in a 3-session, 6-hour tutorial. And frankly, I think everyone could benefit from that. Even learning the fundamentals you might have forgot, plus other key ways of picking your strike price. And again, today, as on the class, I'm sharing my opinions and my views. And again, we don't do specific recommendations. So when I show you a strategy or something, it's an idea, and it's not a recommendation or advice. But yeah, we're going to get into it here today. And if we want to start out with that CPI number, here's basically what I've been seeing.
Jim, give me just one, before you get into this right away, let me just say one more thing to our crowd, because I think it's important. Guys, this session is for you. So if you have any questions or any remarks, please do not be shy. Put them into the Q&A box of your Zoom window. The more the merrier. We will be more than happy to go through all these questions, to address all your questions. So this webinar is for you. It's up to you now to make it your own. Perfect. And Jim, before we get into the CPI numbers,
Sure, sure, sure.
actually, well, actually, right now, so CPI just happened, and how do you see its impact on future market conditions? And if you want to share your screen, Jim, by all means, please go ahead. Screen sharing is enabled.
Okay, I'll start out by putting up the 10-year Treasury note because that's the one everybody has been thinking it's going to collapse. And let's see if that's going to be the fact here, because inflation and the interest rates kind of go hand in hand here. So let's start out with that. And by the way, I am encouraging you to ask your questions, whether it be on something on a stock that you're trying to figure out. I can share my opinion and my view. Is the screen up there okay for you?
Yes, we can see
Okay,
it.
good. And so, yeah, so please do that because, I have been doing this a long time and I have a certain amount of information I can share with you, and maybe a fresh set of eyes isn't the worst thing in the world on some situations as well. So I have the 10-year note up here, and we're going to talk about one side of the Fed mandate, which is called inflation. Now, again, we went into the COVID, right? And they printed so much money that the Fed balance sheet went up to $9 trillion from about 4 trillion. That sounds like a lot of money because it is a lot of money. Now, obviously, they did that because they panicked that because of this epidemic, the whole world was going to go in the toilet, and they can't have that happen. So they were throwing checks in the mailbox, right? You remember, right? Everybody's getting, it was like helicopters of money, that kind of thing. All right. Well, it takes a while for all that money to, come out of the system and everything. So again, the inflation went to 9%, and that's why they had to hike the rates up to 5.5%. And so now that inflation rate has come back down to a little bit under 3. They wanted to get it down to 2. So if it's at 2.9, it's still 50% higher than their goal, right? Now, obviously getting it down to that last 2% is not an easy racket when they've printed this much money. The unemployment situation is obviously everyone's working, and they all are making more money than they used to. And they're still spending. How do we know all this? Because the retail sales just told you it was twice what they thought, more than twice what they thought, jump. And the wages are still growing. Okay, everyone's saying, oh, it's slowing then. Hey, the wages are still way higher than they were. And then as far as unemployment is concerned, yeah, it's not at 3.4 anymore, okay, but it's only at 4.3. And again, they said it ticked off this Psalm rule, which supposedly means you're in a recession or are really about to get in one. And even the lady who runs the Psalm rule, Claudia Psalm, says it might not be the same this time because of the COVID stuff. But you saw the Japanese people just dumping their carry trade. And the carry trade just means that they borrow over there at like no interest, and they come over to the US and they buy stocks and they buy bonds using some kind of borrowed money. So it's a carry trade. And when they unwind it, obviously they're going to sell their US assets, which they did, a couple of Mondays ago to a big way. But the point I'm saying here is that, the one side of the mandate is inflation, and the CPI is definitely not going up anymore. But don't forget, this is on top of the 9% that we had a couple of years ago. So there's been no deflation. It's just not going up as fast as it was. And thank God for that. Now, the interest rates here, this is the 10-year note, and I'm showing you it here for a reason, in that it looks like it's trying to roll over. And they definitely tried to bring it down underneath the purple line here, and that comes in around 386. So what have I been telling people? I've been telling people that the support for this thing is around 385. Now, recently it went to 370 or something. As you can see, it dipped through, but now it's back above. Now, these lines up here are indicating that the trend for interest rates are down. Okay, so, and the RSI is under 50. So I'm not fighting. Yeah, sure.
Sorry to interrupt. Can you maybe clarify for those of you who are listening to you for the first time, what are these lines that you're seeing on that chart?
Yeah, these are moving averages, and there's two things I like to use is the relative strength and the moving averages. Why the relatives? Why the moving averages? It gives me an idea of the trend. The red line is the shortest one, which is a 12 SMA. When that turns up or down, the market generally goes in that direction for a while. When the green, which is 24 and 36, obviously longer term averages, when they confirm the direction of the red, sometimes you will see it go on a substantial move. For instance, when they all turned up down here when we were at a 0.5% interest, do you notice that interest rates were rising for a very long time because all the lines are rising? And then basically, when they try to roll it over here, but the blue line is not turned down, right? Then they only come down for a little bit and then right back up again. Now, right now, the blue line, red, and the green, I would call green and blue kind of flat. Red is trying to turn down. What am I saying is if they got interest, if you heard yields were getting back above 430, I think this idea that rates are going to be cut a lot between now and the end of the year would go out the window. Now, why wouldn't rates get cut? How about because the GDP is rising? How about because the unemployment rate, the claims came out today way lower than people thought, which means the job market is not in bad shape and the wages are still growing. And if you're wondering if people are spending, they did spend quite a bit, twice what they were expecting. Now, some of it had to do with this auto sales thing because they had a little glitch the month before. I don't know. The restaurants still seem pretty full to me. So the bottom line is if they're wrong about inflation coming down, if they're wrong about the labor market getting soft, then rather than everybody plowing into these bonds, they could start dumping them. And if they start dumping them, then these yields would rise. If you see the unemployment report jumping up towards 5%, yeah, then you're going to get much lower interest rates, and the Fed may have to cut rapidly because if unemployment starts jumping to 5% or better, that means the spending is going to go off the board, and 70% of our economy is people continuing to spend. And the credit card support system is also getting a little weaker because people are finding out they're underwater on their credit cards, and so they're backing off a little bit. So there's two-way risk going into the end of the year. There's no doubt about it, two-way risk. And you saw it in the last month. I mean, for gosh sakes, we went from 5,700 down to 5,100. Now we're back at almost 5,600. That's in 4 weeks. And the VIX went from like 11 to 65, and now it's back at 15. So obviously there's a lot of uncertainty out there, a tug of war between recession and just a reversion trade, and the economy's fine and growth will continue. Soft landing versus recession, right? So that tug of war may not be over. Now, as we go into Labor Day, a lot of times the markets rally, and that's kind of what you saw here today, including a reversion, because people got very excited that the retail sales means that everyone's out there spending money. Of course, they're spending it at Walmart, the Dollar Tree, Wayfair, and everybody who discounts, but they're spending. Now, and of course, they're using Amazon, which is another discount factory too, right? So basically, like I say, what do I think of the CPI? I think it just confirms to me that they're not out of the woods yet on inflation. And one of the biggest parts of inflation is called owner's equivalent rent, which has to do with real estate. And real estate prices are not backing off, and rents are not backing off. In fact, they were up twice what they were supposed to be in this last report, owner's equivalent rent. So that is disconcerting because it's a big part of CPI, and you can't crack CPI unless you crack real estate, right? And matter of fact, you don't go into a recession without cracking real estate. I mean, everybody here who's over, I don't know, 30, I guess maybe it's getting to be like 35, has to know what a recession looks like, right? And that means generally people are losing their jobs. The GDP is dropping. People's spending has been curtailed. And, the price of your home probably went down about 20%. None of that's happening. So that's why the recession call got thrown out the window this week, and everyone jumped in here like it was the last can of water in the desert. They were running after that can of water pretty fast here. You got to be careful chasing things after they happen. I'll show you on the S&P where I was kind of very interested in it because I believed in the reversion trade. And I said in my newsletter that everyone got this week, I said, hey, we're up here at 5,700, right? My moving averages are underneath the market. I'm expecting a minor reversion or a more significant one. Now look at that. There's my moving average came in at what? What's the average at? 51.23, and the low was around 51.20. So, I mean, it's almost like right on the number, right? So the bottom line there, 51.19 was the low. Yeah.
And
So
Jim, just real quick for our viewers who may not know this this
yeah,
charting software, this is bar charts, and what you're seeing here actually is a weekly chart showing the last 5 years of price action. So every bar
yeah.
is basically 1 week, and this blue line that Jim just pointed out, where price wicked down to, is his 36 moving simple moving average, and which
Yeah.
acted beautifully as support, as we can see.
Yep. And these are the averages I trust. These are the ones I believe in, that after decades of in the business here, I've come to the conclusion these are pretty darn good. And when they do things like this, I know they're really good, right? And then, of course, when you're down here, like I said in the update last week, a reversion to the upside is in order. And that's exactly what has occurred. Now, again, the reversion could have stopped at 54.50 where the red line is, but it actually went through it. So now what I'm thinking is possible is we might be going after this gap up here. Now, there's a little gap up there, and it comes in between about 56, 30, 56, 20, which is another 75 points or so from here. So that's very possible as well. And again, you have some gaps now underneath as well. Now, again, you'll notice that if you're really going on a long, big run, all the averages are above the blue line and rising. That's not the case here. So chasing it up here might be ill-advised from the standpoint of, maybe it's going to run right up to 5,900. Who knows? But I'm trying to start initially trying to get into it here, is something you have to be a little bit careful of because of the fact that, again, look at the chart when it looks like it's going on a big run. You see everything's on the up. You see it down here on the up. So again, getting above blue is very important. And so that's really where I would keep my get out of town card, which is 54.75. I was 54.75. So if I did anything up here being bullish on S&P, I certainly would want it to stay under here, because if it gets under 54.75, it could go back under an already declining green line, which is 54.42. And then, of course, if it ever got under red or purple, you'd be going back in the soup again. So the bottom line is, and I'll tell you right now, I'm anticipating the potential for a difficult September. So we got 2 weeks before September, right? And going into Labor Day, the enthusiasm may very well continue. But after Labor Day, you're going to have, actually starting next Friday, you're going to get PCE. So if the PCE number is hot, then obviously that's going to make it tough to, keep talking about cutting rates. Then right after that, you're going to have the jobs report on the 5th of September, right after Labor Day. Then you're going to have this debate from the president coming up. And then after that, you're going to have the Fed meeting. And of course, you got CPI on 9/11. I don't know if I like that date, CPI. Anyway, so there's a lot hitting the fan here. And if the market has been bid up going into that, that could be the vulnerability neighborhood, not even counting Ukraine and Russia, not even counting, the Israel and Iran and everything else over there. So there's a lot of stuff going to, and of course, don't forget, after earnings are all out, there's no news to help you very much until October when the September earnings come out. So that's what makes September vulnerable, and that's why I'm always looking on where the puck is going, and that's where you got to look. Okay, so I just outlined a little bit of what the future could be, and that's why you have to be careful of chasing things. Would I have debated you that it's a good time to take a shot at it right here on the blue line? Of course not. That's where you were supposed to do your load the wagon. Now it's up here. It's kind of like you plant the seeds here, and now your plants are growing. You don't plant seeds after the season's already growing. The risk is different. And your probabilities change.
And Jim, this actually brings up a really good point, because what you said hit it to the spot, because your risk is growing. Now you kind of missed the bandwagon by quite a bit. You would have to go into that uptrend much later at a much worse price, and you have no choice but you put your stop loss potentially all the way down there at this blue line, I would believe, or maybe a bit higher, or I guess just below that swing point. And this is a huge risk. That's a massive stop loss. And of course, you want to get in when prices are down and your risk on the table is minimal, which is not the case anymore.
You'd like to have the exit somewhere near the freeway. You know what I mean? So that obviously your differential between buy and get out is fairly tight. Of course, that's one of the reasons I like these strangle ideas, which we'll get to later in the broadcast, because the risk is fixed on them and you have a period of time of which you have the right. And if you can keep the window between the two strikes very tight, you'll notice that that is not a bad thing to look at either. Again, don't forget we have the chat box. So, is there a market you're interested in that I could look at? Is there a stock you're interested in I could look at? You might as well take advantage of the fact that I've got my information up here, and maybe a little insight from what my view is might be helpful to you. So, feel free to put in any
Yeah.
stock or anything else. Yeah.
Let me throw out a question there, Jim, before we get some questions from the users. What are some of the stocks or options that you are currently tracking, which to you, no matter what the option setup may be, are of interest to you right now?
Well,
Give
like
us
I say,
some examples.
I'm looking forward, into next week's activities, which are coming up. And so basically, the ones that have earnings coming out next week is interesting. But I'll tell you right now, I did something with Google and I might do it again next week. When my averages get together, I call that a traffic jam. And like any traffic jam, it doesn't last forever. And so the bottom line is that, when you're in a traffic jam, somebody acquiesces at some point, and it's either going to be the bulls or the bears. So right now, Google came down here. Now, like I say, I thought it was going to, let me show you, this is a better one here. Then I'll go back to this. Yeah, you see all this? This is called the traffic jam. Red is hitting purple. That's a big deal. It's a big deal. Okay. Well, I'll tell you why it's a big deal, because I think on SPX it did that, and you saw what the resolution was. This is on S&P. This is a good carryover, so you get the idea here. Okay. Yeah, well, this didn't get quite as close, okay? But you see, this was getting right into this neighborhood, right? And so when it gets into this neighborhood, it's either going to blow up or come down. Now, with the purple line rising, the bet is it's probably going to break up, because this is a long-term average telling you that the long term is still up, which means these are called reversion to the means, which means that's what you take advantage of. Sometimes they bring it a little lower than the line, and I think that's just a bunch of market makers trying to grab a bunch of people's stock, get them real nervous. They know it's not going to keep going down. And basically they put up their dough while you're panicking, and then they get it back above purple, and then they can breathe easy because they know they're back on the bicycle. But at any rate, what I'm saying here is that as you get closer in here, there's a good chance that it's not going to stay in that little tight window. And that's when a strangle makes a lot of sense to me. And that's an example of it now. So let's go over to Google. Now, Google had some news where the government's supposed to break them up. Some people say that's going to be better for Google. It's supposed to maybe put 20% of the value on the stock if they broke them up. So that's pretty interesting too. But at any rate, you see you got the red line pointing down. That's a negative. But the stronger line is the purple. And so the bottom line is when it was here, I thought it was going to take a big dump down to gold. So I took a shot at some puts at 165 here. And basically, when it went down to 160, I dumped them because I saw in my 5-year that it was hitting blue. And I'm not going to fight blue. I'm not going to fight blue because I'm not going to make money unless it gets through blue. And it was having a heck of a time to get through blue. If it got through blue, I would have held on. And then I think it would have gone here and I would have made a big hit on those puts. But that wouldn't to be. But the point I'm trying to say here is that this thing is probably going to go back up towards 175, or it's going to go into the dumper down here possibly. And I think that creates a very good volatile situation. And sometimes these premiums, because the market has just been meandering around here, they have come in pretty good.
And guy, and let me backtrack a little bit, guys. What Jim is referring to, or the option professor is referring to here, he was mentioning a strangle trade. Now, a strangle trade is what we call a non-directional trade. You will make money if you set up a strangle the right way. If volatility picks up and prices are starting moving, it doesn't really matter in which direction it will move, as long as prices will move. This is when you can make money with the strangle trade. And the way to set it up is basically you will buy a call out of the money and you will sell a put out of the money. And ideally, since you're buying these two things, you want the options
correct,
premium.
Daniel. You're buying both sides. You just said something about selling the put.
Oh, I'm so sorry. Buying a call and buying a put. So that was a miss speech, so to say. So you buy both contracts, the call and the put. And of course, since you're buying, you want the premiums to be as small as possible. Of course, nobody wants to spend more than he needs to. So you want these premiums to be small, and ideally at the same time, the expirations of the call and the put to be as close together as possible. Because that way, price doesn't really have to move that much for you to be in the profitable area. So it's a non-directional trade. As long as price moves up or down, you can be profitable on that one.
And with this kind of situation, because the lines are crossing there, because your reversion trade could take you well up to the 170, 175, maybe fill this gap. Look at the gap. Could take you all the way up to 183. And on the downside, it could take you down to 150 and change. So there's a potential for significant volatility. And that's what makes that interesting as well. So, but again, I haven't priced them out, and I haven't made a determination if it's hits the criteria. People were wondering about the 250 number here, and they said that looks like red. I don't know if it's coming off as red in anyone else's computer, but that's gold.
That's right.
So 250 is gold. Red is the 12.
Yeah, I also just clarified this in the chat for everyone.
Yeah. But yeah, so anyway, that's an idea on the Google that I'm looking forward to, and then there are a number of stocks that are going to have their earnings coming out here, and I'll
actually talking about earnings, Jim. We do have a question coming in from a listener, and he's wondering what's your take on Nvidia prior to earnings, because we know
I'll show you
Nvidia.
Last week we talked to people about doing a bull call spread using a 104 call, and so obviously that worked out pretty good. And I'll show you why I was interested in it. Okay, NVIDIA. Okay, first of all, you go to the 5-year graph, and is that right to the penny, or is it just me? You see, that's where you take your shot. Okay, why do you take your shot there? A couple of quick reasons. First of all, you got the blue line telling you to take your shot, and then you've got the former highs in this neighborhood. If they're former highs, technical analysis 101 told me that they are now support. So that's a good reason, and that's a good reason. So 90 was really the deal, but I didn't really get it out on the alerts until it got above the green line, which was last week. And once it got above the green line, I say it looks like it. And they got earnings coming out on August 22. And if you notice from all the big guys, you know, the what do they call those super scalers like Meta and Google and, you know, the rest of them, they were spending a lot of money on CapEx. And if they're spending a lot of money on CapEx, good shot is they're buying NVIDIA stuff. So when they announce, they should have pretty good earnings. Now, what will be the key to these guys? It'll be what is their guidance? Because some people believe that everyone has bought so much of this stuff without any ROI, return on investment, that will slow down looking forward. And that would be the Achilles heel. So if this thing runs up to 130, 140, or even if it makes a new high, let me show you what I would be thinking. You see here, your RSI is 78. If this thing goes up to 130 or 150, and the RSI right now is at 63, if it can't take out 78 on a rally after earnings, then I would be concerned that it could be tapping out up here, particularly if they announce their guidance is not that great. Because I'll tell you one thing, one of the reasons Walmart went nuts today is because they guided higher. And believe me, investors love guiding higher. I mean, they'll pay up for that.
Jim, two things real quick, just to clarify, how do you define guidance? And secondly, when you say if the RSI can beat the previous high in the RSI, what would this constitute? Would it be a divergence in your point of view? So please do these two things, guidance and divergence.
Sure. Okay, guidance is everyone's got a report card when they go to school, right? And you're going to bring your report card home to your parents. Well, rather than your parents, it's called your shareholders. And basically, you bring this report card home, and there's anticipation, right, on what's in the report card, which is backward looking. It's going to tell you what the last semester was, right? And then they're going to tell you, the student's going to tell you how well they're going to do or not well they're going to do in the next semester, right? So guidance is the next semester. The earnings are what has happened. So obviously something that's already happened, okay, may not be that interesting to people unless they're way off. Expected everyone to get B's and they got all A's, then that's an upside surprise and the stock may go up. You expected A's, believe me, they're expecting A's on NVIDIA. If NVIDIA came in with B's or C's, believe me, the stock would be in trouble. So the bottom line is that the earnings tell you what has happened, and there's an anticipation of that. But for people who are really going to be interested in staying with a stock or getting rid of it, it's really what the guidance looks like. And you'll notice that some of the companies that had bad guidance, they got hammered because people don't want to hear things are going to get worse. So the guidance again will be NVIDIA will be giving you an idea of what they think their future backlog of orders is going to be. They also have the problem of, can they make all these things to fill the orders? And that's where Taiwan Semi comes in and people who make the chips. So that's basically what the guidance is all about. And
as far as on the RSI and the divergence.
And the RSI, I'll try. Let's see if I can show you some examples of it. Okay. All righty then. RSI hit 71 up here, and then over here was 55. So again, you're up here at 140. Now you're up near 140, and you're nowhere near the 71. So that means the car is running out of steam. Once it got back under here, it was totally out of steam. And then basically it gave you a nice big drop. So the reason I like to look at the RSI is I compare highs. This is a high over here of 69. And this is a high over here of 59. That's a divergence. Tells me the car's running out of gas. Once it gets under the red line, not only do I know it's running out of gas, but now it's running downhill. So I like to combine running out of gas with the direction, because sometimes it could run out of gas for 2 days and then start jamming through the roof. So I really want to see some type of a red line going down. I'll give you the 1 month graph. See, this thing was running down since 128, pretty good all the way down. And then it turned up down here at 102. So this thing, like I said, I got the thing here at 90 because I have a longer term graph that said 90 was it. But basically, where's your RSI here? 34, and then it's up to 40. And then basically it's climbing. So this thing obviously was turning. But divergence means basically that you're going to be looking at a high point against another high point, and the relative strength is going to be higher than it is on the second attempt. And same thing on the bottom. You have
exactly.
You have a divergence here, and basic numbers that I like is 50, 60, and 40. 50, 60, and 40 are ballpark numbers I like. What does that tell me? If you're above 50, your car's running pretty good. You got a pretty strong engine. You get it above 60, potentially you can go 70 or 80 now, right? Because your car is really starting to move. And when you go 70 or 80, that's where the big bucks are made in calls. On the downside, if you're under 50, your engine's losing value, losing power. Okay. If you get under 40, that engine light is really on, and you could get a dead engine, which means you could accelerate to the downside. So the big bucks in options, in my view, is when you get RSI going through 60 on its way to 80, or you get it going through 40 on its way to 20. And then there's still money to be made in between the two numbers, but those are the ones where if I'm in something, I get a feeling I'm onto something big. So that's just a ballpark way of doing it. Yeah.
Thanks, Jim. And the question came in, this ties into what we just discussed in terms of earnings and guidance. Where do you find the guidance figure? Do you have any specific site that you consult, or is this posted with the earnings? Where can you find that number?
Well, Yahoo Finance is a pretty good one, I think, but there's probably 9 million up there. But you just, you Google the earnings for XYZ company, and I'm sure there's a little blurb up there about, okay, they were expecting this on earnings. They were expecting this on revenue. Was it a beat or was it a miss? And what was the guidance? So it's generally in the report wherever you read it. So just look up the report, and the big things is what were the earnings per share and what was the revenue? Now, the problem with the earnings per share is if they made a lot of money because they fired everybody, or they closed down factories, or they sold off something or whatever, but their revenue is not moving up at all, that's not something of interest, because you can only cut so many people to make money. You want to see that revenue number jumping. That's why people are freaking out on Nvidia, because their revenue went up like so ridiculously high, and that's why the stock went from $40 to 148, and that means $400 to 1400. So because it's 10-to-1 split. So yeah, that's the guidance, the revenue, and I'll tell you right now why I'm concerned about September is, you can't run away from the valuations. The CAPE ratio, which is a PE. Now, PE means what? You have a price of a stock, and then you have the earnings. So say a stock was going for $10, and it made $1 of earnings. The PE ratio would be 10-to-1, because you get $1 against the price of 10, right? So obviously, if you got if you had a stock that was going for a lot higher and you only had $1, then the PE ratio would be much higher, and that means the stock might be overvalued. So this CAPE ratio goes inflation adjusted. So it mellows out a lot of the vibrations of up and down that can happen. It does a 10-year inflation adjusted. And it's at around 34 as of August the 8th, which is twice the normal rate. And the times where it's above 30, the stock market has had more difficulty. So I would say that we have to be careful of, that's what I'm saying, chasing things after they run through the roof, not my game. Because again, we are in high altitude up here. And
Yeah,
so
the air is thin up there, so you have to definitely be careful. And
yeah.
chasing a trend or something that's overextended is rarely or seldom a good idea.
Well,
It's
I'm
better to
very
be patient.
and I'm
Yeah.
very comfortable with that two-sided trade, Daniel. I mean, it's nice to have a parachute when things like Intel happen. I mean, frankly, I thought Intel might go up after earnings. And one of the ideas that I had was getting a $32 call, and that was like $125. Thankfully, I threw $50 at the put at 28 as an insurance. And the next thing you know, rather than not going to 36, it's down at 20. And rather than making money on the call, you're taking $800 out of a $50 deal on the put. So things happen. People are very naturally, right, used to insuring their house and their car and their life and their boats. Sometimes a little insurance on some of these things you do with your money is not the worst thing. Obviously, you have to be careful on how much premium you pay and this and that, but it's not a bad concept from time to time. And talk about volatility. I mean, some of these stocks have been up and down in the last month, where both the options on the calls and put could come in.
Yeah. Jim, talking about this, guys, as you know, I'm going to grab back the screen just for 1 second here.
Sure.
So let me just do this. And Jim, I'm going to take away the screen from you. Let me just do this right now so you guys can see what I have to show. There we go. All right. So as you may know, we do have an options alert service where the option professor every Sunday will send out his option ideas to all our subscribers. Basically, a summary of what he is considering for the next week to be of interest. And it's very precise, very actionable, because we call out, and this is the a summary here of what we called out at the end of July heading into August. We're calling out what is the option play, whether it's going to be a strangle or a vertical spread, or perhaps an outright call. What is the expiration? What are the strike prices to be considered? And what are the average costs? And you can take advantage of these option ideas. And typically, it looks something like this. And Option Professor, would you like to perhaps comment on some of these calls that we made at the end of July and how they panned out, and how you would have not only taken that trade, but also managed the trade throughout and get out of it eventually?
Sure. Well, there's no exact science on getting out, and I don't give any ideas on getting out. So basically, these are notifications that indicate that this stock and this expiration date and these strike prices and that premium seems very reasonable, that they are going to benefit from significant volatility. That is the notification. That is the idea. Now, let's go through some of these. JetBlue was trading around $6 when I looked at this idea. And the premiums were very low, as you can tell. So $6 call, and it was before earnings. So we had a $6 call going at a 550 put on this idea. Total price was $68. That means your maximum risk in the history of mankind on this wonderful idea was $68. Okay. What happened after earnings? The stock spiked up to about $7.30. Obviously, then the call option is in the money. You have the right to buy at $6. If the stock is at $7.30, then you're in the money by $1.30. Obviously, that's more than a double practically on just the call. What happened after that is, and obviously you can take your profit up there, and then you don't have to sell the put because the put's going to be almost at zero. And so does it make any sense to sell out an option that's almost at zero? That still has maybe 10 days to go? Maybe not. So basically the 550 put, the stock ended up going back towards 450, I think, or at least $5. And so they went in the money and there was value there. So basically that one got two-way traffic because the stock went up and down. Pfizer.
Jim, stay with that. Let's stay with JetBlue just for 1 second. Just also maybe comment from my point of view on this, because there were some very important things that were said here. First of all, and we do this in our options alerts, we are sorting and ordering our ideas by the approximate cost, because everybody has a different risk tolerance. And of course, since we are buying option contracts, you want the cost to be as low as possible. Of course, always in correlation with what the actual outright price of the underlying is. So this is something to consider. The lower, the better. The second one is you also want your strikes to be as close together as possible, to as close to the actual market price, because that means, the stock doesn't really have to move that much from the current price to get into the money. The more narrow and the strike prices are, the better it is. The closer they are to the actual market price, the better it is. The lower the cost of the overall trade, the better it is. So that's number one, which is important. Number two, as equal as it is, getting out of the option trades. And I think, Jim, you told me before this webinar, you check your trades on average perhaps once or twice a day. And you may have a routine when you do this, and maybe you can comment on this in just a second. So you check your trades, you see what has moved, what perhaps went into profit, and then you make a decision. Okay, let's perhaps close out one of the two legs of this options trade, ring the register. There's nothing wrong with it. And as you said, perhaps the other one is now so close to zero, it doesn't really make sense to sell this one, because what you would get for it would be minimal. So why not keep it open? Expiration is still a long ways out. In this case, if you would have taken the trade maybe on July 29, you still have 10 days left. So perhaps something else will happen. This is exactly what happened with JetBlue. The stock price plummeted in the aftermath, and you were able to also book your profit on the second leg. Of course, it doesn't always work like this, that price fluctuates this much, but as long as it goes up significantly or down, you should be in the green.
And, the other thing you could do is you could move, if the stock is up at 730 and you're at 550, obviously if you got out of the 550 and moved it up to 6 or 650, you'd put a little bit more money in. Well, you got the extra money that came out of the call anyway. And then when it rolls over, rather than a 550 strike, you could have a 6 or a 650 by just putting in a little bit more money. So there's a number of things you can do. But just sitting there doing nothing in this particular case, you got activity on both sides. And Daniel's 100% right. A Pfizer stock, we had a $1 window for $128, and the stock got earnings, and it came down to 27 and change. So obviously the puts in the money by at least $2 or $3, and obviously that would jump the put premium up probably towards 3. Apache Corp, or used to be called Apache Corp, is a energy stock. Another 31.30 for 170. Again, they had earnings and they popped down towards 27. So that got a good activity on the put side. This regional bank was a really good one. because I saw that they had a big run from like 40 something up to the high 50s, if not 60. And I thought it was that was a reversion to the mean type deal. The moving averages were all down at 52 and 51 and 50, and we were up at 60. So I believe in reversion to the mean. And so basically, I thought this thing would come back down pretty good. So I thought this could be a very significant potential. So I thought the idea of the 61 call and 58 put for $175 was very reasonable. And that stock dropped down towards 52. So the puts obviously would be in the money by 6. And you only paid 175. That is called a good deal. Again,
Yeah.
how do you lose money on this? It would stay in between the strikes and the time runs out and you never get out for whatever reason. And it can go to 175, goes bye-bye. So again, the good news is these are limited risk stuff. And the other thing is spread it around a little bit as far as, and look at it as a long-term deal. In other words, if you have X amount of risk capital and you put it all into 1 week stuff and for whatever reason that week we don't get volatility and then you draw down your risk capital, you won't see the new ideas that come out. So, I like to be, a little bit, conservative as far as, how many I would do and what I would do. And you guys are all out there. Most of you are trading. You know what a stock chart looks like. You take these ideas that I'm notifying you on. You go look at your charts. A lot of people change the strikes and the expiration dates. Sometimes these expiration dates are a little bit short for some people, so they put another week or two on it, put up a little bit more money, and then maybe they get more money. Starbucks was a classic example here. Anyway, with Intel, you already heard the story on Intel. So there's 178 and the thing went to 800. Starbucks. Yeah, when we had this thing open, the highest Starbucks ever got to was 81. So basically the calls were $3 in the money, still higher than $2. But had I just bought another week or so, we would have caught this little change of the CEO and the stock went up to 95 and I'd be taking out almost $2,000 on $200. So again, people do adjust these ideas. These are not, you have to do the exact thing. This is somebody notifying you that this stock, this setup is indicating volatility will be happening shortly. Then you, as a citizen of the world here, can make the adjustments on the strikes and the expirations as you see fit.
Jim, real quick before you get, there's something I think that would be of interest to many of our listeners is what's your routine look like? When do you check into the markets? Do you do it twice a day or perhaps just once a day? Or when do you usually monitor your option trade? What's your routine there?
Well, I think, at the end of the day is a nice time to look. So you see where they went home. Obviously, when Intel announced, and of course, I mean, if you're in something that's announcing earnings, that would be the day where you'd keep an eye on it. Like today, when you go up to $75 on a Walmart strangle, I'm sorry, on a call and put on Walmart, and you go $5, $6, $7 in a move, those calls are going to get lively. And so basically that would be a day that you might start taking something off the table on the first thrust, because a $7 move on Walmart in one day is a pretty good sized move. And, again, you don't have all day long, you don't have forever on these options. So when the money's in front of your face, sometimes you grab it and then you go look for another setup. There's a lot of ways to come out. I like to grab the money when it's there, but there's other people who, like I say, maybe use a 5-day moving average or some type of a moving average and try to stay with it until the moving average breaks. That's not a bad idea either. As long as you're not running out of time too much, because, again, if they go adversely and the time runs out, then you're in big trouble because you have no more time on the clock. So the bottom line is a couple of ways is either take the money and run, like the old song said, or use a very short-term average. And as long as it stays with the short-term average, you ride the horse as far as it'll be until the knees buckle a little bit. But again, the beginning of the day is nice to look at it, or right around when the earnings came out. Sometimes these guys announce earnings before the open. So obviously you want to see where it opened. I think that's case in point on JetBlue. I think the opening was way up like that. Because, if everyone is positioned a wrong way, and they come out with news, that's a lot of people having to cover and get long. And the market maker is going to take advantage of that and really raise the offer, which I'm sure that's what they did to Walmart today. A lot of people, because Walmart was trending down as early as last week. It was down at 68, 67, pointing down. So a lot of people probably had some selling strategies going on. And once they came out with that guidance that things are going great, well, everybody who had all those negative positions had to buy them back. Well, who's on the other side is the market maker. And what's the market maker saying? Okay, $75, you want to get out? Here it is. And then once they got all out, you could see the price didn't continue through 75 very far. So again, if the report's coming out, you want to keep an eye on it because volatility can be big if people are not used to what's coming out. And then the second thing is at the end of the day, you see where they take it home.
Yeah.
So those are two times to look.
And Jim, I got some questions that came in. I think these questions are a great segue of what's coming up next, because I have a whole bunch of questions asking, how can I get hold of these alerts? How do I get them? And let me quickly comment on this one, and then we can go back to some of the price charts and some of these symbols that were requested. So guys, we actually do have an options alert service. We call this the triple play alerts because there are three types of options plays that we're calling out in these alerts. These are ideas that have been identified as interesting by the option professor. And these three types of trades are strangles, the ones that we just showed in that table. And so that's the first one. The second one are limited risk option writing plays. And the third one are long-term directional plays. And this is a great segue because we had some questions about this. And before I answer those questions, guys, if you are interested in trying out these alerts, all you need to do is to go to www.tradingindicators.com/alerts. I'm also going to put this into the chat box right now. And while I'm doing this, let me answer two user questions while I am typing in the address into the box. The first question was, how do you set up a strangle trade? How do you do this? Is this just considered to be just one consolidated trade, or do you have to place these two legs individually? So this question was asked, and let me just quickly type in the URL here before I mess it up. Multitasking is good, but sometimes it can lead to errors. So the URL is now in the chat box to try out these option alerts. Now back to the strangle. How do you place them? Well, a strangle by the very definition consists of two legs. The first leg is buying a call contract out of the money, and the second leg is buying a put contract out of the money. Some brokers will allow you to do this as one single trade where you specify both legs at the same time. I think most brokers will allow you to do it. Perhaps some other ones you have to do it individually. It depends a bit on your broker. If you want to know all about how these strangle trades work internally, when do you break even, how much money can you potentially make with these strangle, in fact, this is kind of unlimited there. We did record an entire masterclass on this topic, the topic of strangle trades and some other option trades that we are calling out in these option alerts. And this masterclass, guys, is actually included in your subscription. So if you sign up at tradingindicators.com/alerts, you will get the full recording of our 6 hours options masterclass led by the option professor. And we're going to start off from very basic things. So what is an options contract? How do you set up a single outright call or an outright put? And then we're going to continue to the more complex option strategies, such as strangles or straddles, such as vertical spreads and other ones as well. And we're also going to talk about managing your options trades and how to find interesting options ideas. This is all covered in this masterclass, included complimentary if you sign up for at least 1 month to our options alert service. And the best news is that the actual month only will cost you, the very first month, only $97 for the first month. Then it will go up to $197. So I believe this is a great deal. On top of this, you will also get access to our members only trading sessions, which happen every Tuesday at noon Eastern time, and our Discord channel, in addition to other discounts that you will get with your subscription. So I think there's great value and very little on the table in terms of risk if you want to take advantage of this current offer at tradingindicators.com/alerts. Now, let me comment on another question that came in, another great segue. The question was, does the option professor only do non-directional plays, aka strangles or straddles? And the answer is no, absolutely not. It's one part of the options alert service that you will receive. In fact, that's part one, which are short-term strangles. But we also have directional plays such as vertical spreads and long-term outright calls and puts. So these are also part of your options alerts. You have, kind of a mix of everything that the option professor is considering, and this is very important for his own trading, because all these ideas, they come straight from what the option professor is considering for his own account as well. And Jim, would you like to comment on this perhaps a bit? Did I get this right?
Like I told gentleman I spoke to, is I don't do every single trade out there, and nor should you. So, you have to look through the universe there and find ones that you think, are up your alley and in your budget, because everyone has different suitabilities, right? Everybody has different, amounts they're working with and all that. So you can't do a one brush on everything. I do, and as far as different trades, in the alert from last week, we had a bull call spread on Micron technology that has gone through the roof a bit for us, and on NVIDIA using a 104 call buy and a 114 sell. And that already is deep in the money, so that's good. And then we have credit spreads where if you're looking to get cash flow, we had a credit put spread on Broadcom, which has really gone way up. So those puts are going to zero nicely. And then we had a call credit spread on Microsoft saying it might not get above 470 anytime soon. So, there are different strategies out there, because some people are looking for directional. So obviously the Micron and the NVIDIA ones are directional. And then they have some looking for cash flow creators. And so we got some of those going. And then, of course, we've got the strangles where I'm trying to look for those trades where, the moving averages are all coming together. There's some news coming up. The premiums look pretty darn reasonable. And so we get on both sides of it. And as long as we get some volatility up or down, we should be coming out okay. So I think it's a pretty good menu. And I think there's something there for everybody for sure.
I agree. And we're going to come back to this. So guys, one thing to consider, tradingindicators.com/alerts, only $97 for the very first month. And this does include our 6 hours options masterclass, which alone is $197 plus access to our members only trading sessions. All right. And one more thing about this, you can expect your alerts to be sent to your inbox every single Sunday before the week starts. It will come straight to your inbox. And as per user request, starting this Sunday, we will also include a printable PDF in your email, which you can simply open, print it out, and then you have it on paper and you can follow along these option trades. And just like a menu in the restaurant, you just pick and choose. Pick the ones that you like, that taste the best, or that seem to be most appealing to you. And this is exactly what we're offering you, a menu of option ideas. All right. So, Jim, so this is something to consider, and the link is in the chat. And now let's go back to some of the user questions that came in. Let me just quickly go here. I'm going to start with, how often do you send the alerts? The question came in. That is every Sunday. Another question came in here. This is more of a technical one. Can you execute option trades in a regular cash account, or does it have to be a margin account? I'm pretty sure it needs to be a margin account, but Jim, do you have a take on this?
I do. I believe in the cash account, you can do purchasing of calls and puts, and that's what we're doing with the strangle. Again, we don't want to do strategies that have unlimited risk. Why? Because you could be right on those strategies 8 times out of 10, and the other 2, if you don't handle the volatility correct, you can really get yourself in a big pickle. Just imagine if you were selling puts and calls in the last month. Well, you sold the puts, and during that drop to 5,100, they needed a gurney for you. And then you sold calls, and it went back up to 5,600, and then they needed another gurney for you. So the bottom line is that we want to do limited risk strategies only, and you can do now. You can't do. I don't believe you can do a call spread or a credit or
Yeah.
debit spread. But again, the strangles are just vanilla ice cream. You're going to buy a call, buy a put. There was one question here, and I'll show my age here a little bit because when I was doing thousands and thousands and thousands of options a month, I used to do combinations and our strangles, but I might be selling the strangle or buying it, whatever. But I could do it on one ticket. We used to call it a combination on the ticket. Now the word is strangle on everything, and I work with a couple of firms, and they don't have a combination ticket. So my experience has been is you got to do one side at a time, which means you got to do them quickly, because obviously you're trying to get both of them done pretty close to the price you're trying to get. And that means you have to click on one and have the other one pretty much ready to go right away. So during fast market conditions would not be the time to place your strangle. In other words, you'd want to do it when the market is somewhat sanguine, so you can get both sides done at a fairly close to what you're trying to get. But yeah, you might ask your broker. You go, and that's what you got to do. I mean, if you're at Robin Hood or Hood Robin or wherever you are, Tasty, whatever, you go up to these people and you go, listen, I'm thinking about doing what they call two-sided trades called a strangle. Do you have a ticket here where I can put both of them on the same ticket and then put a limit order for the strangle and basically get filled all at one time? Because that would be ideal, because then you'd know exactly what you're going to pay for the strangle to the penny. If not, you're going to have to be Jack be nimble, Jack be quick a little bit and get them both done. And of course, there's a little nerve wracking to try to get them done at the same time. But generally speaking, these things aren't going crazy every 2 minutes. So yeah, it's either you have to do them individually or you do it on one ticket. And if you have a cash account, my belief is that you can do buying of options in a cash account. Now, again, everything we say, you got to go to your broker. You got to ask him if it's okay where you are. You got to ask him if it's okay for you, because they're the ones who know suitability and they're the ones who know risk tolerance. We don't know that. So again, you always talk to the broker about things like that.
Perfect. And Jim, I was typing some answers here. So two things came in, and the one question which I think makes a lot of sense. Question was, when do you consider a premium to be reasonable? So let me take this away. Maybe Jim, you can chime in just afterwards. So first of all, if we are buying options and these option ideas are vetted by the option professor, then the premiums will be reasonable for what we're considering. So that's number one. But what you need to do, and this is absolutely crucial, when you open up your brokerage account and you actually look at the actual cost of setting up these option trades, you want to make sure that it's still in the neighborhood of what we were considering as reasonable. If, looking at JetBlue and then the premiums for setting up the strangle are at, like, I don't know, 130 now, twice as much, that is a warning sign, and you may want to stay away. Because markets change as they open, and these approximate costs will not be exactly the same. Sometimes they're going to be even less. Sometimes they're going to be even more, depending on what happens in the market, correct? So you need to double check this, of course, whenever you want to place the trade, that the premiums are still in the neighborhood of what we were calling out here. A bit fluctuation, of course, is to be expected, but it should not be completely off.
One other thing is that you can consider changing your strike prices that would fit into the budget if you think the volatility may still be good. Meaning, let's just say here, the $6 and the $5.50 were 68 cents, and the market went up to where that was at $1. Well, you might go to the 6.50 call and the $6 put, and maybe that's trading at 68 cents. And if you think it's going to 7.50, there's still a possibility of making good money. And of course, in that case, you would have even made better off because you would have made money on the call up to 750 or so. And on the move down to 450, you'd then have a $6 put, not a 550. So you can adjust your strikes if you still think the volatility is significant and you want to play the prices right with regards to the premium. Or the other thing is if the premium is moved and the market's moved, it's called did not play, which means you go to the next one or another one, or you wait for next week's ones. What you don't do is act like money's burning a hole in your pocket, like you're 7 years old, and you just are spending money like a madman. You have discipline, and discipline will have you around a lot longer than random walk.
Absolutely. Yeah, a very good keyword there. As a trader, you need to condition yourself and train yourself to be disciplined. I know it's not easy because you always have FOMO, the fear of missing out. But believe me, FOMO and trading do not go well together because, so oftentimes you may see Bitcoin, and this is a completely different topic, Bitcoin going up, and you want to jump on the bandwagon, and it's now at 70,000. It's going to go to 100,000. And next time I'm going to borrow something that Jim used to say, faster than you can spell Bitcoin, it's down to like, I don't know, 45 or 50. So do not chase the trend, wait for the right moment. And if the moment has passed, so be it. There will always be another one. So discipline is important. Jim, another question came in, and let me just quickly pull up. Thank you for the response. Yeah, no problem. One question came in about the VIX from Kenneth. He is asking, Jim, option professor, do you have a preferred way to use options to hedge a portfolio, such as index puts and calls on the VIX? Yeah, please go ahead and share your screen.
Okay, good. First, I'm going to show you the VIX because I think it's very, very important today, and I'm glad you brought it up because, again, VIX and volatility and options are kind of like peanut butter and jelly. Okay, so what am I doing here? I'm hitting share, or what am I doing here? I don't see the word share anywhere. Oh, down the bottom. There you go. Hey, I know a lot about options. I'm just not familiar with all the buttons on my machine. Okay, so are we seeing the chart?
Yes, we can see it.
Let me explain something about the VIX because this is very important. And this is my opinion and my view. Big money is not going to get into the stock market if the VIX is above 20. Okay. Why wouldn't big money want to get involved in stocks if the VIX is above 20? Because it's very unstable. And people are going to put in $1 billion or 100 million or 50 million or 25 million. They don't want to put it into pandemonium. So when the VIX is above, and that's why notice what they did, those New York Stock Exchange people, when it got up to 65 here, how quick did they get it under 20? Oh, in like a few days, because they know that people with big money, if it stays up here, they're all going to want to come out because they don't want to have their money going up and down like that, right? I mean, you don't like your accounts going up and down like that. Believe me, if you have $100 million in there or more, you certainly don't. So anyway, and again, what I told people is in April, you see in April after earnings, we went from 13 to 21 or 25, 22. I thought that we were going to get that bump again because this was the end of earnings, right? And so I thought we were going to get another bump in August, July, and we did. We went from 12 or 11 up to 20. So that was a nice bump. I didn't know they were going to have a Japanese carry trade emergency, and that's what that was all about. But look where it is now. Where's my moving average? 1484 on both of them. Big number. What was the low today? 1477. If that VIX is bottom, this stock market's coming down. Because if this thing's going back to 20, then stocks by next week they'll be coming off. So I got to be careful now. But it's under 20. And as long as it doesn't go way back up, the stock market could keep going from the standpoint of it's under 20 and big money can be probably convinced to add to their stock portfolios because the markets are stable and their brokers can say, oh, look, it was just a reversion. Oh, it was a false alarm on recession. Come on back in. Let's get that money in there. And so that story can resonate. It can't resonate at 65 because you sound like a moron that it's just a pullback because it looks like a collapse, right? So Right now, I would be very keen on watching that number of 1477 low and the 1484 number. Again, I say if it gets above 17, you see that's where the blue line is at 1682. If it gets above 17, it might open, and of course 19. So those are your two numbers. There's three numbers right there: 17, 19, and 22. If we get above all three of those numbers, then I think we're back in the soup again. So I'd be careful, because one thing I always think is whatever's going on is not what's definitely going to keep going on. And so I'm looking for signs that what's going on is not going to go on any longer. And since a rally is going on, what would make me think that it's not going on anymore? That VIX jumps above 17, that VIX jumps above 19, that VIX jumps above 22. And then you may find that we're in a different world. And in the last month, we've had two different worlds, right? Recession, everybody getting out. Happy days are here again this week, right? Let's talk about hedging, because that was what I just wanted to show you the VIX, because I think that's kind of important, right? Don't you think? If it's hitting a support line like this, and we just had a rally like we had today, you don't. Tomorrow's Friday. You don't see a big follow through tomorrow. You're going to understand why, because the VIX just hit 1477, and it's not, and it's bouncing off of that area. Okay, all right. Let's talk about hedging. Now, there's three things I like to talk about with hedging. And I'm going to talk about hedging a stock like, what would be a good stock to talk about hedging? Now, let's talk about Apple. Half the world owns Apple, right?
Indirectly, maybe through my iPhone.
Yeah. I mean, if you own a mutual fund, you own it. If you have a thing called AAPL in your account, you definitely own it. Okay, so here's the deal. Apple right now is right in this neighborhood here. Well, let's look at it. Here's what I always do. I always talk about the 20-year graph. Okay, and I'll tell you, let me put the RSI up. So I'm going to walk you through my mentality here. And by the way, we have these mentoring sessions. So if you'd like to have a one-on-one and go through all the things you want to learn on a one-on-one basis, that's available to you as well. All right, so let's see what the RSI is telling us here. At this high point back in 22, RSI was around 74. At this high point, RSI was 62. Again, that's a divergence, and you reverted back to the mean, right? Okay, now we were here. We were at 74, then we were at 62, and now we're way up here in the ozone. It's only 64. That's not the greatest, 68, okay. That's not the greatest, though. So 240 is a number you could make a statement in until it's taken out, and of course it's extended. You could think that that's a number that you could live with as far as hedging, right? So basically, let's use 240, and then let's go over here to, and there's a divergence I saw, so there could be some weakness coming. Here's your 5-year. What does the 5-year tell me? High point 76, high point 64, bang, back to the purple line. Now we went way the heck up here. RSI was 69, still not higher than 74, and we had a reversion to the mean. Now we're back on the bicycle. Is it going to blow out this thing? It could. Where's the RSI now? It's at 65. Remember what I told you about 60? Once you're in the 60s, you can go 70 or 80. You've been in a car, right? You're not going to go from 20 to 80, right? But once your car starts cooking at above 60, hitting the gas a little bit to go to 70 or 80 ain't hard, right? So there you go. You're in a position where it could blow out the high and go nuts. But this is under the idea that you want to protect your $225 investment right now. And so that's what this is all about. But I'm trying to tell you, it's going to be very interesting to see here, because it obviously is binary right now. And on the 1-year graph, again, your high point here was 78. Big new high up here is only 73, not a little bit of a divergence. And look at that reversion. Now we're back up here. Where are you over here? RSI was around 50. And up here, your RSI is about what? 59. Again, it's banging against 60. So we'll have to see. It might be going for this number up here. But let's just say, for instance, we want to hedge it here. Okay, we go over to the option prices. And I'm going to try to give you some example here. Let's say between now and the end of year, you want to have some downside protection on Apple. Okay. Let's say you had 1,000 shares of it and you bought it at 165. So you have 165 grand, and now it's worth 225 grand. So you got something to protect. Okay. But you want to have upside potential because it looks like it could still go, but you don't think it'll go much above 240. So let's go to the December contracts. And let's look at the 240 calls. And you see they're going for $7.25. Okay. So if you own it at 225 and you agree to sell at 240 plus $7.25, that means you're agreeing to sell it at 247.25. So the first way to protect yourself on a hedge is to just do a simple covered call. And that would give you downside protection. Again, you brought in $7 at 25 cents. So if you are at 225 right now and you take away 7.25, you've got downside protection to 217. So that means the stock could go down to 217. And if you collect this premium, your principal is protected at 217. Below that, you have risk. Your upside potential again, another $15 plus 7. So you got about another $22 on the upside as a ceiling. So you have a ceiling at 247 and a quarter, and you've got a floor at 217. In the middle, you're just holding it. So that's covered call writing. And again, what I would suggest is if it were to go up to 240, you would buy back the call and then either say, okay, I had what do you call it? I had $22 of, I had $15 of jump. So as long as I can buy this thing back for less than 22, at least I'm still seeing my account grow. So you can either buy back the call if it hits 240, or you could buy it back and roll it up. That means you buy back at 240 and sell a higher one now at say 260 or 250 to bring in premium that might be able to pay off the difference between the 725 and where you had to buy it back. So that's called rolling up your position, which is basically your ceiling was 240 and you're putting a new ceiling in. Yeah. And what you're trying to do is bring money in to pay for the differential. That's covered call writing, and that's called rolling up your position.
Great explanation, Jim. And if you want to learn this in more detail, I recommend the masterclass where we are discussing exactly this strategy, including rolling up your position in much more detail. So thanks.
And
Jim,
also two other tactics that are important, which is called the collar, which is where you take your $725 and then you buy a put underneath with the money they gave you at 240, and then you create a ceiling and parameter that way as well. And the final one is you get rid of your stock at 225 and replace it with a limited risk call. And then you've got a position on a call option with limited risk. So if it keeps going, you can participate with Apple rising to some degree. But if it goes in the tank, you don't have any risk beyond the premiums. That's called a replacement trade, where you're replacing your stock with call options. Yeah. And that's why the master class obviously is very important, because you'd have the master class at home. You could watch it more than once. You could take notes. And if one thing or another happened, you had a question, you could always email us your question. We'd be more than happy to try to help you.
Perfect. I'm going to grab my screen back just for 1 second, Jim. A quick reminder, guys, that what you're going to get with the Options Triple Play Alert Service, you will get every Sunday directly to your inbox and printable as a PDF our 3 categories of option plays. We get short-term strangles, which are non-directional plays. You get limited risk option writing options, where you actually have immediate cash because you're selling premiums and you're buying lower price premiums. So for lower limited risk, and you have immediate income. And we have our long-term directional plays, which have expirations, give or take perhaps 4 to 6 to 8 months out. And, we're looking for the big home run plays in this one. So everything is available at tradingindicators.com/alerts. And this is combined with one more extra, which I didn't mention yet, is the Options Professor's Market Commentary, a distilled version of what has happened, what has transpired in the markets, and what the Option Professor sees as coming up next as important. So it's a great read. We include this in our Options Alert email as a complimentary feature. So tradingindicators.com/alerts. And not to mention, of course, the first month for only $97. And this includes our options masterclass, 6 hours of recording. So worth way more than the 1 month only, worth itself just for $197, but you will get the first month for only $97. And you will also be invited to our Tuesdays live market sessions, which typically take place on Tuesdays at 12 p.m. Eastern Time, as well as access to our Discord channel. So guys, if you're interested, I think this is a great deal. All you need to do is to go to tradingindicators.com/alerts. And if there was a question which was left out so far, now is the time. Guys, if you haven't put your question yet into the Q&A box, yeah, you better hurry up because we are nearing the end of this session. And perhaps while you are typing, a quick reminder, if we overlooked anything or you just want to have a question that you don't want to ask live in this webinar, no problem whatsoever. You can always reach us through our homepage, tradingindicators.com. In the top right corner, you have a link to a contact form. It's called Contact. It opens up a form and you can type in your question there. And this question will go straight to my inbox. I will make sure to answer every single request. And sometimes I even delegate these questions to the option professor because he would be in a better position to answer it directly. All right, so let me quickly see if we have any questions coming in. Greg wants to know, is the subscription a calendar month or 30 days? It's a month. It's a calendar month. So it's it will renew on the same day every month, Greg. That's yeah, it's not 30 days. It's the exact same date. So if you sign up today, today is the, what is today? Good point. Is it the 15th?
15th?
Yes, the 15th, exactly. So if you sign up today on the 15th, it will renew in September on the 15th. So it's as easy as this. All right.
And I did want to add that the new report goes out Sunday. And for next week, there's quite a bit of earnings like Palo Alto Networks. And you've got Toll Brothers and TJ Maxx and Zoom and Target, Burlington Northern, Baidu, Dollar Tree. So there could be quite it could be a pretty fertile group out there. I'll be analyzing all of them, and I'll be coming out with the things that I think look best.
Perfect. Yeah, something to look forward to. I look forward to these alerts every single Sunday. It's fascinating, the variety of ideas that the option professor goes through for his in his research. It's quite stunning, and I know Jim. Yeah, he's last time I think you pulled an all-nighter to get so much out. Yeah, it's good stuff, guys. I recommend it. So it's tradingindicators.com/alerts if you want to come on board. All right, so one more round of questions. Greg says thank you. All right, guys, you're welcome, Greg. Thank you so much, Option Professor, for being here today. It's always fun to have you on board. I thank you all, guys, for spending this, yeah, what is it, Thursday evening today with us. I'm losing track of time. I know your time is precious, so this makes it all the more humbling that you take out time out of your days, out of your busy lives to listen to us talk. I hope we made it worth your while, and I'm already looking forward to our next session together. Until then, guys, happy trading. Bye-bye.